9 months ago, when everyone had written an obituary for Indian markets, there was one man who came on Nifty now and said, look, I would be buying Indian rupee and I would load Indian stocks. Jim Walker, that man is back. Let's understand his latest prediction. Jim, good morning. Table thumping applaud to you for your great India bull call, and that call was very timely. Now that the world is bullish on India, what is your call on India?
Well, be more bullish still. We're really just at the start of the story in India again. We've had 2 years of very weak growth. We've had certainly 18 months of companies repairing their balance sheets and getting themselves back in order again. We've got 5 years to go in an upcycle in India, so we think it's very much at the early stages of the stock market story and indeed the India story again, which this time I think India will be leading the story of emerging markets because it's at least 2 years ahead of China in that respect. It's cleaned out its system and now we start to see the benefits again.
I love this guy. He's bullish and he's been perfectly right. But Jim Walker, what about the risk factors? Election, high inflation, high interest rates, rich valuations and a weak macro.
The macro will turn itself around. You're quite right, it's weak at the moment. I don't expect that to change really in the first quarter. But I certainly think by the second half of the year you'll start to see a slight acceleration again in the Indian macro story. And with that, because companies have been cutting capex, they've been beginning to improve their margins again, you'll very see it quickly coming through to corporate profitability. But yes, the risks on the political front and potentially on one or two of the economic sides, inflation and interest rates. The politics we've tended to put to one side. Obviously, there's one outcome which would be extraordinarily bullish for the Indian stock market, but we've tried to say to our clients, buy Indian stocks regardless of the politics in India. The reason for that being that the way that the companies have acted over the course of the last 2 years and the prospect of an upturn in the economy independent of the government who's in government. It would be nice to see a government that makes decisions and could actually start to unclog some of the investment and infrastructure pipeline, and then we'll get much better growth still. But we haven't even factored that into our call. And as for inflation and interest rates, inflation's going to come down in India. The last 2 years of falling credit growth, falling money supply growth, have already taken care of the inflation story. That was a story for 2011, 2012, 2013. I think we'll be way below the Reserve Bank's target of 8% by the end of this year. We're almost there already. Quite possibly we could be close to 6% on inflation in India. And with that, the scope for interest rates to fall.
So, Jim, the question is, what does one buy right now if someone's missed out on the, rally off late? Because there seems to be this sector rotation happening where exporters and, the boys which have held out so far are sort of easing out, the likes of IT, pharma, FMCG, and there is emergence of riskier sectors, if I may term them so, banks, infrastructure, even underdogs like cement.
Yep. These cyclical stories, and in particular things like cement, the construction side, the infrastructure stocks, industrials that are cyclical industrials, small caps and medium caps, these are the places that if you can buy them, that's where you should be. In fact, we've just put out a note this morning from the companies saying that one of the US ETFs that monitors the Indian small cap story, the Indian small cap sector, has just broken out for the first time in almost 4 years into an uptrend. And with that, the strength, the relative strength of that index is improving. And what we see is a major rebound in some of the small caps and medium caps that were really hit hard over the course of the last 2 years and were down anything up to 70 to 90%. That's where we would like people to be concentrating their firepower if they can find out which companies are the good ones to buy. Unfortunately, as an economist, that's not really my strength.
Jim, let's talk about the US markets as well, the big mother market. And US markets are now exhibiting classic signs of a bubble formation. big M&A deal. WhatsApp has been valued at $18 billion. 20 IPOs will hit Wall Street this week. What happens if US markets crack and correct?
Which is what we expect to happen during the course of this year. Not so much on the back of these deals, although, as you quite rightly say, they just indicate a bubble top. But the US market has become completely reliant on money creation. The Fed creating, at this point last year, $85 billion a month, money out of thin air. Now it's only going to be creating $55 billion a month. It's still quite a lot of money. But our view is that as that money goes down every month or every FOMC meeting, which is what we expect for this year, and ends at zero in December, then the markets are going to find it harder and harder to go up because they've just become so used to this real monetary inflation. As that monetary inflation dissipates even, then we expect the US equity market to go down. So by the end of the year, we're expecting around about a 20% correction in US stocks, but that not to flood back over into, for example, emerging markets like India.
So,
Jim, how serious a problem could the China slowdown turn out to be? Because that in a lot of ways impacts India as well.
Yes, although in some very good ways it impacts India, because I think people will be shocked during the course of this year how slow economic growth is going to become in China. And the result of that will be certainly much weaker prices for things like copper, industrial metals, and quite probably oil as well, all of which are beneficial for the India story. But if we just think about what's happened in India over the course of the last 4 years, when in 2010 we had 10% economic growth, by 2013, 2012, 4% economic growth, that's exactly the picture that we should be thinking about for China. It's coming off around about 7.5 according to their numbers last year. This year I expect it's going to be between 0 and 4, and it will be there for at least a couple of years, just as the same way the Indian economy slowed down. Although the big difference in China, of course, is that it's got much more in the way of overcapacity to get rid of in the system. India had no overcapacity, still has no overcapacity. China has a lot harder job to do than the Indian economy did, so the prospect of below 4% growth, I think, is very real in China.
So, Jim, if your view is that global liquidity will become tight, interest rates in US market, in US economy will move up, US markets will correct by 20% plus, why are you bullish on India? Because the plank on which markets always rally in the short term is always low interest rates and a lot of cheap liquidity.
Well, it seems that way at times, but the fact is that if you go back to the period of real Indian and emerging market outperformance in the last decade, which was between 2004 and 2007, even slightly earlier than 2004, what you'll find was that was an era of actually high interest rates and rising interest rates globally. And yet emerging markets were the big outperformers relative to the developed countries. And not just outperformers relative, but outperformers in absolute terms. They rallied very strongly. I think we've got into a very strange pattern over the course of the last 4 or 5 years, thinking that stock market rallies are dependent on very low interest rates and money creation, central banks. In actual fact, the stock market is reliant on the private sector, the ability of the private sector to generate profits. It does that when economic growth is high, and it does it when companies are disciplined. Now, in India, when economic growth is high, interest rates are high. That's all there is to it. That's the way it should be in every country. And when the companies are disciplined, which I would say is exactly what's been happening for the last 18 months in India, when economic growth starts to accelerate again, it goes right to the bottom line. You see huge increases in profitability. And at that point, stocks, which people say are expensive today, suddenly look very cheap. So what we really want to get back to is a world where interest rates are rising, along with economic growth, and where company discipline produces high profitability. That's when stock markets go up, and that's the conditions that we see in India just now.
So, Jim, do you expect the RBI to hike interest rates come the April policy?
Kind of the view now, actually, as inflation at the CPI level begins to come under control, and I think it's going to be increasingly under control. And as you've been pointing out earlier, the rupee is pretty solid at the moment. That's putting downward pressure on imported inflation as well. As that continues to be the case, there's probably no need for the RBI to raise interest rates further from here. I wouldn't mind if they did. I don't really care where interest rates go at the moment because companies aren't borrowing. And as long as companies aren't borrowing, then the interest rate signal from the RBI is pretty irrelevant. And if they were really just trying to say that we're very, very, very serious about inflation, maybe another rise would be a good thing. But actually, I think they probably could just sit back now and say, we've done the work already, we've been doing for the last 2 years, now we'll reap the benefits and just plot a steady course for interest rates and let inflation take care of itself, which I think is already baked in the cake.
Right. So, Jim, at 67 odd levels on the rupee when we spoke with you, rupee was a buy for you. At 60.25 today, what's the call A on the rupee? And we are at lifetime highs on the Nifty, 6,600 plus. How much more upside from here?
Oh, I think in the Nifty and the stock market's huge upside. I'll certainly be looking for it going through 7,000 over the course, maybe not quite of the next 9 months, but certainly a year from now I'd be looking at India well above the 7,000 level. The rupee, I wouldn't like to see it strengthening too much more. I think at 61, 62, the rupee was quite good value and was giving exporters a bit of relief. I was in India in February, and it felt really quite cheap to be in India and spending money there with the rupee at 62. It wouldn't be that expensive at 60. I don't want to see it going to an overvalued level where we begin to see a deterioration in the current account position again. What we're looking for is the current account to move into surplus in the middle of this year. Only cyclically, not a structural surplus, but on a cyclical basis. But we need the rupee probably around about the 61, 62 level. I'd like to see it stabilised around that level over the course of the next few months.
Jim, so what will happen to the current account deficit once the government decides to really bring import duty restrictions down on gold? Bulk of the CAD control in India is a function of gold import restrictions. Somewhere down the line, those restrictions have to go away.
Yeah, although by that time, my expectation would be that the inflation picture in India, which I would say to you is one of the key elements in people buying gold and desiring to have gold as a store of value, the inflation picture will be much, much more benign, and therefore the demand for gold in India, although I think it's quite sensibly a strong demand and should continue to be a strong demand over time, but in a cyclical sense, because of the reduction in inflation, I would expect strong demand in India to be much weaker than it had been before the restrictions went in place. So I don't think the rise in gold imports is going to be a huge factor again in terms of the current account deficit. As long as I'm right about inflation, it stays on a downward track, I think there's nothing to worry about uplifting the restrictions on gold imports.
So, Jim, is there any money to be made in precious metals, gold or silver this year? Or do you think one is safer to stay put with equities?
I think in India I would be weighted much more towards the equity market at the moment than perhaps the precious metals market. But I tend to be a gold bull by nature, purely because I'm a central bank bear. And most of the central banks around the world are still finding it very difficult to stop printing money. So with that in mind, I would tend to be much more bullish about gold, especially if I were an American or a Japanese or a British person, which I am, although not located in Britain. Those countries I would be very long gold relative to other assets. In India at the moment, I think with the cyclical turn in the economy and the prospects for equities, I would probably be slightly reducing my Indian gold holdings and putting it into Indian equities.
Jim, so at the current juncture, if you have option, let's say, to just execute one trade, and if the shelf life of that trade could be 1 year, which is one trade you would like to execute a punch?
Well, I think a good trade would actually be short the renminbi, long the rupee as a trade for the next 12 months.
China go long on Indian rupee?
Long the Indian rupee relative to the Chinese renminbi.
Anything from India which you like, which could be a big trade for the year 2014, specifically when it comes to Indian equities, sectors?
Well, our big recommendation to our global clients just now, and it's one of our high conviction global trades, is to be long the BSE 500 rather than the Nifty or the Sensex, purely because the BSE 500 brings in a lot more of the bombed out stocks that were hurt in the cyclical downswing in India. So that for us remains one of our highest conviction trades in the global economy. We told people to cut their S&P 500 positions last year, go along the BSE 500 at the turn of this year. That's something that we're very happy to continue saying to our global clients.
Okay, 10-second response. Would you buy BSE 500 or Indian stocks before election verdict or after 16th of May? Just a 10-second response.
I'd buy them now. That's even less than 10 seconds.
Okay.